Well, what we're seeing, of course, is a very significant impact of the new trade tensions between the U.S. and a number of other countries. We've seen a flurry of tariff announcements since the end of January with countermeasures from some countries. And all of that is very heavily coloring our outlook for this year and next year. So a reference estimate, which is based on measures announced up to and including the April 2nd Rose Garden tariff announcements and some of the countermeasures immediately after that, finds a significant downgrade to global growth to about 2.8% for this year and 3% for next year. That's about 0.5 percentage point lower for 2025, and cumulated 25-26, it's 0.8 percentage points. So it's quite significant, and it's hitting all the regions of the world. We're seeing lower growth in the US, lower growth in the euro area, lower growth in China, lower growth in other parts of the world. We're still expecting inflation to continue coming down, but not necessarily as much. And we have a slight upgrade to our inflation forecast by 0.1 percentage point this year and next. So the global disinflation path continues, but what we're seeing also is a different impact on different countries. So to give you a sense, for instance, for the US, what we're seeing in the US is quite a significant uptick to headline inflation, about 1 percentage point higher inflation in 2025. And some of that is coming from the tariffs. It's not just the tariffs, there is also underlying strength in services inflation in the US. Taken together, 1 percentage point higher inflation to 3% in 2025. So inflation has stopped coming down in the US from last year to this year in our reference forecast. What we see is in the US is the tariffs acting as a supply shock. So that's lowering output and that's increasing price pressures. Not the good news for a central bank, because you're facing a difficult trade-off, and the higher price pressure is something that you have to get under control. But there is also the increased uncertainty, and the increased uncertainty, which is related to the fact that no one is able to tell where things will settle eventually, means businesses are pausing investment or purchases, and that's weighing down on activity that could continue. And that's a negative demand shock. It's going to reduce price pressures. And then on top of that, you have the fact that we have these incredibly complex supply chains that have been built over years, and how the shock is going to propagate when you have parts, intermediate goods that are crossing in and out of countries, and if they're going to be tariffed in one way and the other way, it's very, very hard to figure exactly where this will land. So in that context, what we anticipate is the Federal Reserve is already announced. They're going to take their time, assess where it's going, and really they will need to respond if they see price pressures emerging, and in particular if these price pressures lead to some de-anchoring of inflation expectations. And that's one of the risks from our perspective when we look at the overall situation. Well, what is really important here is to make sure that central banks are able to do what is needed to anchor inflation expectations. And what that requires that everyone understands and trusts that they will respond, they will look at the development on the price and inflation front, they will look at the developments on activity, employment, output, and they will do what is necessary to make sure that inflation remains near central bank targets 1 or 2 years out. And that credibility of central banks is absolutely essential, and central bank independence is a key component for that credibility. But we are seeing the risk of a recession happening in the US as an increased risk. We are, according to our calculations, that risk has increased from about 25% back in October to a little bit, almost 40% now. So that's a significant increase. Now our assessment at this point is that that depreciation of the dollar reflects, in fact, the weaker growth prospects for the US. Let's remember that we're coming out of only a few months ago, everyone was marveling at the strength and resilience of the US economy. Some of that is weaker now, and there is a reassessment that is going on. So there is weaker growth prospects, there is more uncertainty, and overall that leads to some adjustment in the global demand for dollar assets, and that is weighing on the dollar to the downside. tariffs themselves, directly the effect of the tariffs, would tend to go in the other direction. So it's the uncertainty and the weaker growth that are driving the adjustment we're seeing in currency markets. But it's important to keep in mind that this adjustment has been orderly. We are not seeing dislocation in currency markets. We are not seeing a stampede or run to the exit. We're seeing some rebalancing of portfolios coming from years of very strong capital inflows into the US, very strong performance of the US economy, of equity markets. Some of that rebalancing is natural. So we're not concerned at this stage about the resilience of the international monetary system. It would take something much bigger than this. But for instance, for the US, with 0.9 percentage point downward revision, about 0.4 in our assessment is coming from the tariffs. For China, the overall downgrade is 0.6 percentage point, from 4.6 to 4%. But the impact of the tariff is actually much bigger than that. It's about 1.3 percentage point. So what's happening here in the case of China is you have a bigger impact of tariffs, which is understandable because China is very exposed. It's an exporting country. It's exporting a lot of goods, in particular to the US. But this is offset by stronger fiscal measures that have been announced since the beginning of the year. They are providing support to Chinese growth to the tune of about 0.5 percentage points. So the overall 0.6 number reflects a balance of forces, and the tariffs are actually a big component for some countries. China is one of them. Other Asian economies are also very impacted. Mexico is very impacted in our forecast. Growth is revised downward by 1.7 percentage point, and a lot of that is coming from the tariffs.
Canada also.
In Canada is 0.6 percentage point revision. Some of it was already factored in our January update. Right now there are bilateral discussions. What's important is to settle on a set of rules that businesses and countries can understand and follow, and that will help provide support and remove the uncertainty that is weighing down on global growth.